So just touching on what Kathleen said there about the Bank of England, I mean, how do you kind of play that? Do you short the pound?
Yeah, I think this, look, the central banks at the moment, it's a really interesting play because Jerome Powell surprised us all with a little bit of a dovish pivot in a way. And then we've seen the other Fed members coming out trying to water that down a little bit to say, look, you know, we still are going to see material rate hikes going forward, at least for the rest of the year. And they are still primarily focused on inflation and particularly core inflation, which continues to remain pretty elevated almost everywhere, as you pointed out. I think, though, it's interesting you bring the RBA into this, where Governor Lowe actually described this really well.
Yeah.
Clearly, central banks are trying to now, and we shouldn't dismiss what Jerome Powell said last week, central banks are very clearly trying to navigate that soft landing that they've all been talking about. So while talking about the inflation pressures, you look at somewhere like Australia where headline inflation is still accelerating and is expected to accelerate. The central bank revised up their inflation expectations, and that data will be released in all of its detail tomorrow. But clearly focused on unemployment. And it's interesting that Governor Lowe talked about how he didn't want to give up the gains that were made during the COVID stimulus on bringing unemployment down and beginning to lift wages. So clearly these central banks, and I expect the Bank of England will be similar, and it will be interesting to see whether they bring about this sort of pseudo-dovish pivot as well, where they start to talk about what happens after the rate hikes. And I think that's going to be key today for the Bank of England.
But given all of those that you just mentioned, then how does that play that into your convictions in the currency market? It very much sounds like it's still a dollar story here.
Absolutely. And so from our perspective, we still have a 98 target for the euro dollar, for example. So just dipping below parity, remaining pretty strong into the end of the year, largely as well because we think real interest rates, which have come down a little bit of late in the US, which did put up a bit of pressure on gold as well, for example, brought the dollar a little bit softer. We think the dollar begins to strengthen again into the end of the year before we get that peak dollar environment, I guess. The same with respect to the pound. We actually like to be long the US dollar, short the pound in that context, just because we think that the economic situation in the US, particularly with respect to energy prices and so forth, it isn't the same set of issues that are being faced in the UK, in Europe, and so on.
Wayne, I mean, what effect does quantitative tightening have on all this? I mean, we've seen such a huge amount of liquidity in the system. If you look at M1 going up from about $4 trillion to over $20 trillion from March 2020, and the tapering process going on right now, not tapering, but actually what we have is them coming in selling bonds. I mean, surely this is going to play out with the dollar in terms of a headwind.
Look, I think that you raise a really interesting point there, Rush, and the QT, in a way, is like a pseudo rate hike in that context. So when Jerome Powell made those statements last week, it was almost a little bit like they're trying to navigate as well the path of rate hikes relative to the pace of QT. Certainly one thing with respect to QT is, given the rally we've seen in 10-year yields, for example, that you would expect to see a bit of a pushback on that, and we actually think that 10-year yields, by the time we get to the fourth quarter, should be back around the 3%, for example, in the US. So this is also going to play out, as we talked about at the top of the show, with respect to the Bank of England. So the QT is going to accelerate. They are going to potentially start to sell bonds into the market. That is going to push upward pressure on the long end of the yield curve potentially again. So we actually might see, even though we're seeing rate hikes and we've seen this sort of lift to the front end and the rally in the back end, what we actually might see is the back end starting to rally a little bit again as well. So this will complicate the matter with respect to the US dollar. But nonetheless, in the short term, we think that it can still not undermine the dollar so much with respect to the dollar is going to continue to focus on growth in the US being relatively robust, unemployment being very low, and the payrolls number on Friday is going to be very important to continue to drill down that narrative.
You know, we're continuing to see whether or not this supply-demand issue is going to be fixed out. With around $90 a barrel, have we reached peak oil here?
I think, to be fair, we actually think that oil prices go materially higher from here.
Yeah.
In fact, we have $125 a barrel on Brent by the end of the year. Now, the reasons for that are really interesting. So at the moment, the concerns about the demand side are well and truly entrenched in the market, hence the reason oil has stepped back recently and actually over the last couple of months. But the increase that we got from, or the news we got from OPEC last night is really telling to how much spare capacity is actually left in the global system. And to be fair, we haven't seen a material supply-side response from US shale producers, for example, which traditionally happened in the past, which then caused supply to be rising at a faster rate than demand. This time round,
Wayne,
OPEC are clearly telling us they're very worried about the spare capacity side.
Wayne, I mean, we had almost shale as a swing production part of the whole oil complex. Why is that not the case anymore?
I think that, to be fair, Rish, I think the overall globally investment in oil production and oil facilities has been running at a very low pace for a very long time. The interesting thing about the OPEC announcement overnight was that even though it was 100,000 barrels, when you spill it down to how does that apply to the different members, actually it was only an increase of around 30 to 40,000 barrels, right? So largely because the UAE and Saudi Arabia are the only ones with really any spare capacity to lift production from here. Clearly, they are concerned about, particularly with respect to domestic consumption there, but also on a global basis, the issues or the war in Ukraine has also reduced oil investment also in Russia. And so consequently, over the next 18 months, let's not even think about the next few weeks, over the next 18 months, as oil demand, we think, remains positive at around 1.5 million barrels per day growth over the next 2 years, even with a global slowdown, we still see the market either finely balanced or in deficit. And remember that OECD inventories are at very low levels. So even with a bit of softness today, because of all the concerns around global growth, looking forward, we still think oil prices can hold well and truly around or above that $100 a barrel, looking out over the next couple of years.
Wayne, let's talk a bit about crack spreads, and if we get additional supply out of the likes of Saudi, is it the right type of oil? And what about Iran in all this? We've got a viewer question saying that Iran is coming back with 2.5 million barrels a day as well.
Look, I think that the Iran question is always on the table, and up till now we haven't seen a lot of movement on that, the negotiations between the West and Iran, since the Ukraine war, we actually haven't heard any real dialogue about it at all. The point is about Iran is that, yes, they could bring 2.5 million barrels per day back to the market, but in reality, they've been continuing to export about 1 to 1.5 million barrels per day, if you follow the tanker tracker data. So even if they were to come back, and in fact, we actually need Iranian crude on the market come mid next year, otherwise oil deficit will get even larger. Yeah. So I would argue that if we don't have that Iranian oil come back, we could easily see prices around that $120 to $130 a barrel.
Almost out of time, Wayne, but just very quickly wanting to get your views on what we're seeing with the war in Ukraine and weather very much impacting agricultural commodities here.
Yeah, look, we have seen, encouragingly, we have seen some shipments coming out of the Ukraine. Only one shipment actually so far. I would have expected to see more. That will begin to calm nerves, particularly in those key importing countries in Africa as well as in the Middle East, who are very reliant on the Ukraine, and also Russia to that degree. Russia will probably have almost a record wheat crop this year, so getting as much wheat out as possible is incredibly important, particularly for food prices. Yeah. But weather conditions in the US and the crop in the US for corn and soybeans is still under a question mark because it was planted so late. And let's not forget, La Nina is likely to return for another year, and we know that can put weather risks in the Latin American crop. So we are not past the weather risk part of the equation yet, even though we've seen a bit more grain coming to market.